Good afternoon, everyone, and welcome to another one of Avant-Garde's free educational trading webinars. We are so thankful you're here with us this afternoon, and we want to welcome our presenter, Vlad Karpel, as well as Keith Harwood. They are here this afternoon to talk with you all about learning how to manage market pullbacks. We are thrilled to have them. Vlad, are you with us?
Yes, sorry. Yeah,
Hi.
got a good
All right, thanks so much.
was on
Yeah, the
mute.
technology is here. Whenever you're ready, you can go ahead and take over the screen and pull your presentation up. And while you're doing that, I will remind everyone live with us in the Zoom room to please type your questions, if you have them, during the presentation into the webinar chat or the Q&A, and I can get those over to Vlad or Keith to address at the end of the presentation. All right, Vlad, I can see your presentation. Looks nice and clear, so feel free to begin.
Sounds good. Again, thank you, Natalie, and AGT for having me. And today the topic is portfolio management, kind of holistic view on your portfolio, especially when you have uncertainty in the market due to geopolitical risk, war in Iran, private exposure to private credit in financial companies and in the software companies. So there are a lot of risks in the market. So it is important to have a strategy of how to manage your portfolio and how to rebalance your portfolio and how to mitigate some of the risks. So that will be the topic for today. And for those of you who are new, welcome. This is my brief bio. I was started my career at UBS, actually, work at UBS. I have a master's degree in computer science. Spend a lot of my time, my career on the technology side, building infrastructure, building the technology for financial startups here in Chicago. Options Express was one of them. Started Tradespoon in Yellow Tunnel now 12 years ago, 14 years ago, actually, 14 years ago. And that's been my background. And then Keith Harwood from Options Hotline joined me. We joined together 2 years ago to build new models, to do backtesting, and provide signals in the market. So that's my background. And Keith, do you want to give a quick overview?
Yeah, absolutely.
Of
And
your background?
thanks again for hosting us, Natalie and AGT. And yeah, no, I think Vlad, touched on some stuff here, but also for me, about 20-ish years ago, when I graduated from college, I started as a market maker on the CBOE floor. A little bit of baptism by fire. I traded through the subprime crisis to start my career. So hopefully we're not going into something quite like that here with the current geopolitical risk. But I think that, managing portfolios during drawdowns, um, certainly a focal topic right now, given the market conditions, and thinking about how traders and options market makers and every participant in the market can potentially approach the current environment is, crucial in knowing how to avoid that panic setting in. And hopefully we can help you get some insights here today.
Sounds good. Thank you. Again, we went over the disclosures. If you haven't seen them, since we're going to go to specific examples, it's very important to understand the risk associated with trading stock and options. So how do you structure your portfolio? I mean, one thing you do need to commit, I'd say at least 15 minutes per day for adjustments. In a live trading room, I often say that you have these, the current markets are driven a lot by headline news. I mean, you do have definitely technical indicators. You can argue that the market is oversold and should bounce back, and we're reaching, critical level on S&P and technology, small caps, on interest rates and a dollar, right? But ultimately, a lot of the movements are also influenced by headline news. I mean, obviously, to break long-term support, it will take a new information or a new catalyst, positive or negative. But it is important to spend at least 15 minutes a day to review your portfolio. Patience, right? Very often when you see certain levels are broken, like QQ is retesting lows that this year low, we have to go back to all the way to, I think, September to see technology at these levels. You can see Microsoft Meta is breaking down, and you do want to kind of react to these. But again, in the live trading room, usually I would say be patient and at least wait till end of day to rebalance your portfolio, especially if you're looking at the holistically on your portfolio and you have a choices, right? You can be bearish, you can be bullish, or you can be neutral. But if you want to switch from bearish portfolio to bullish portfolio, or vice versa, from bullish to bearish, because SPX dropped below 6,500, I encourage you to make these decisions till the end of the day, right? You want to create process to eliminate fear and allow fun, right? Fear drives all of our decisions, and those are the main drivers. And on one hand, you have fear of missing out, right? Market QQQ is down close to 8 to 10%. Microsoft is down 20 to 30%. Google is breaking down, and if you've been waiting to get into the market, it seems like this is the time to do this, right? So you have fear of missing out that we're going to reach an agreement with Iran tomorrow or in the next couple of weeks, and the market is going to rebound and reach all-time highs. On the other side, you have a fear kind of pushing you in the opposite direction of fear of future regret, right? That if the market does break down and we cannot reach an agreement with Iran for the next few weeks or maybe even few months, and you do have 10, 20% pullback in the market, you don't have cash, right? You get on a margin call, you have a drawdown beyond 20%, right? Beyond 20%. And that's, no matter how you approach the market, it's not fun, right? If your portfolio is down more than 20%. So you want to be able to eliminate making decisions on your biases, right? And on emotions, and kind of have a structured approach to trading the markets. A lot of people don't realize you can be long and short the market at the same time, right? That's a very kind of interesting thing that I learned. I've been teaching and managing TradeSpoon and Yellow Tunnel for 14 years, and a lot of people that have been in the market and even portfolio managers do not realize that at the same time you can be long and short the market, right? You can have, let's say, oil companies. Okay, you can be long oil companies, but you can also short some weak stocks that continue to deteriorate. Let's say Blackstone Group, right? Stocks that are exposed to private credit, right? And you can have certain positions that if the market goes up will go higher, and you can have certain position if the market goes down will go higher. So the idea is you want to be long and short the market at the same time. You can, based on some of the metrics, you can decide whether you want to be have more long positions or more short positions. But this is something like that you want to consider. So there's concept of long short funds, right? Where you can have top 10, best performance stocks right now, right? Right now, energy is performing well. Some of the telecommunication companies like AT&T, Verizon is doing well. And then you can short the stocks, like software stocks are under pressure. You can see that some of the mega cap technologies stocks are breaking down. So you can be long and short the stocks at the same time. You can also use derivatives, right? You can use derivatives to trade instead of being long the stock. Maybe some positions are long calls, right? Or if you want to short the stock, instead of shorting stock, you can buy a put, right? So you can do it on the same individual name, or you can do it on different, right? But the concept of long short funds is very important, right? It's been there, and there's a lot of institutional or hedge funds that trade these long short funds. And the idea is to kind of start thinking as an institutional investor, right? And there's a lot of uncertainty in the market. By end of the day, if there's a positive development in Iran and progress being made on stopping the war, then the market is going to have large moves to the upside, and vice versa, right? If we escalate the rhetoric and we don't reach an agreement, start bombing, energy infrastructure in Iran, and market is going to break through the current levels. So how do you structure your portfolio? Again, need to execute our positions at a lower cost basis, right? Usually when I look at my portfolio, even if the portfolio is going lower, right? But I have hedges like puts, right? Merit puts is a popular strategy, or I have a put spread, QQQ put spread. That lowers your cost basis, right? It kind of reduces when the short positions are gaining the value, right? They're reducing the cost of your long positions, right? And if you have a mindset that at some point we will reach agreement with Iran, and assuming we're not going into recession, then the market will be, potentially at all-time high, right? So then the idea is that you want to constantly reduce your cost basis, whether you're buying puts and making profit on your puts, or you're selling calls, right, against your stock position, or you have both, you're shorting weak stocks. Let's say you think Meta is going to continue going lower because of all the lawsuits and, they now lost litigation where, there's a precedent being made that they potentially cause health issues in people, then Meta could continue to sell off, right? Or Microsoft. Ideally, you want to have less than 5 to 10 total portfolio risk, especially if you start trading and you're new, right? A lot of people want to make 50% return. Very often in live trading, when people say I want to make 50% return, 100% return, you can do that. But then you have to realize that your drawdown in your portfolio will also going to be more often than not 50 to 100%. So when you're new to trading, you want to mitigate the risk, especially when there is uncertainty in the market, right? So I would say 10% if you're new. If you've been trading and you live through 10, 20, 30% pullbacks, then you can slowly increase your portfolio risk to 15 to 20%. Anything beyond 20%, it's very difficult to make trading decisions and not being based on emotions. So portfolio Greeks, we're actually working right now. Natalie showed you the AGT platform, but a lot of platforms, your broker dealers, including very soon at AGT, you should be able to not only, we've had a presentation on Greeks for individual names, right? So if you have a Microsoft call or you have a Google call, you can figure out what the delta, gamma, theta, and positive vega is. But you also have to look holistically on the entire portfolio. What is a delta across all my positions, right? If I have a mixture of stock position and an option position, I want to know what my overall portfolio delta is, right? And if my delta is 0, then I'm market neutral, right? I have some calls, that are being offset with some puts, and then I'm market neutral, right? And if you're bullish, if you think market is oversold and going to hold the position, and the current market will hold certain levels, okay, you can become a delta positive, right? You can have more calls than you have puts, right? Or you can have more short puts than you have short call, right? So overall portfolio delta is important. And I do encourage you, if you're trading options, portfolio delta is important, right? Especially in the current market condition. And again, the idea is to be long and short at the same time, the market. You can do it with option spreads, right? You can do it with cover calls, you can do it with merit puts, but always, build your portfolio that if market continues to go lower, some of your positions go up in price, right? And if the market goes higher, some of your positions go up in price. Because on any given day, it's very hard to determine by the end of the day or by the end of Friday, are we going to, rebound from oversold conditions, or are we going to take out the lows and continue to sell off? So portfolio delta is important. If you sell in premium, theta, overall portfolio theta is important, right? Time decay. I personally don't use vega and gamma on portfolio Greeks, so I can't speak in depth about that. But I know Keith potentially looking at that, and a lot of institutional traders and money managers are also look at the portfolio Greeks. Keith, what are the words of wisdom on portfolio Greeks?
Yeah, I mean, I think the biggest thing is to also understand that like long delta in, CF doesn't mean it doesn't pair off necessarily with long delta in SPY. They're different price underlying, so the delta is going to have a different balance. And I think the other thing, speaking of gamma, when you're actively trading, you can be long gamma, long options, and paying that theta because your position is getting shorter delta on the downside or longer delta on the upside. But it's important for people that are long gamma and paying time decay to be more active on trading. If you're not actively trading the movement, you're paying theta for no real benefit when you go up one day, down the next, up one day, down the next. So there's a lot more scalping the market that needs to occur when you've got a long gamma position. If you want to sort of set it and forget it, the time decay, collecting some time decay can be a big benefit.
Thank you. So yeah, so this is important concept, especially if you're trading options, right? And you have a mixture of stock and option positions in your portfolio. And by looking at these Greeks, you can quickly tell, will your overall portfolio go up if the market is going to go up, or will your portfolio will go down, and by how much? Beta weighting, right, is also very important if you're trading stocks, right? I always say, well, if the market, let's say, right now we're down 1%, 1.5%. So we're down, let's say 1%, right, on S&P. Right? Then the question is, how much is your portfolio down, right? If your portfolio is also down 1% today, then it means you're at beta 1, right? And you can argue that the market is oversold, and Trump is pushing everyone to reach an agreement in the next few days. So you can say, okay, this is opportunity to go long, right? And you know that your risk, if the market continues to deteriorate and sells another 1%, then your portfolio is going to be down another 1%. And if S&P is down right now 6 to 7% from the highs, then your portfolio is down 6 to 7%. If your portfolio beta is 2 because you like to trade, high volatile stocks like Nvidia or cryptocurrency or some of the biotech names, right? And a lot of people make mistake that they're concentrated, the concentration in these high beta stocks, right? So if the market is down 1% and portfolio is down 2%, right? Your portfolio is down 2%, beta 2. That means that if the market is down 6 to 7%, now you're down, 15%, right? And you're approaching to that threshold where you do not want to have your portfolio down more than 20%. So I always encourage you on daily basis, just at the end, when you look at when the market is closed, just see, okay, how much is S&P down, right? And how much is my portfolio down? And again, a lot of broker dealers will provide you overall portfolio beta, so you can determine, how correlated is your portfolio to the market. Keith, do you use beta for your own portfolio management decisions?
Yeah, I mean, I think the biggest thing with beta is, again, understanding what your broad market exposure is. So when the market's falling, if you've got stocks that are going up, right now, energy stocks go up when the market goes down. So if I'm long the energy sector, I don't necessarily expect myself to be worse off when the broad market's going down, given the driving elements of the downside move. So being able to see that beta weighting and understanding your portfolio and understanding where your risk lies is certainly crucial. And knowing that if you've got an options position, your delta is going to be changing, which means your portfolio beta is going to be changing. So,
Got it. Thank you. And I encourage you guys to type in questions if you have any questions. I know we're covering a lot of content, but we want to make sure that we do answer any questions you might have. So again, on AGT, we are building AI agents, right, that can actually look, they're aware, right? There are agents, bot agents that can know what your portfolio looks like, right? What are individual names, and can actually give you some of the, some of the parameters for risk assessment, such as beta, volatility of your portfolio, and Sharpe ratio. Also, very important term. Sharpe ratio, basically, the way I look at it is the higher the ratio, the less riskier, your portfolio, right? The idea of the ratio is to see how much additional return you're receiving for additional volatility of holding risky asset classes, right? Because you can trade high beta stocks and very volatile stocks, but you're taking a lot of risk, right? You want to find asset classes where, and build your portfolio where, you're taking less risk, but, the highest return possible based on the risk you're taking. A lot of people don't realize that if you're looking for 50% return in your portfolio, that means your drawdown will also have at least 50%, right? Which could be more than you're willing to take. Keith, any comments on Sharpe ratio?
Yeah, I think it's a great tool for effectively equalizing or comparing the risk reward of a portfolio. Because if you've got a leveraged long portfolio, simply you've got those ETFs that are like triple the return of the market. They're going to have the same Sharpe ratio roughly as the broad market, just much more volatility. So it helps to understand if you're actually outperforming the market or if you are just leveraging the market direction or underperforming it. And, I think a lot of people forget to do that comparison when you've got a bull market because up money is up money. When it's down, that's when people start to recognize that they were taking risk without getting an incremental reward. And so monitoring it over time can be a really powerful way to understand whether you're doing well, outperforming the market, or just participating in the market in a leveraged way.
Thank you. So some of the rules that we follow in our live trading room and just in general is, you do want to have a barbell approach to trading, right? High beta, high risk stocks should only be 10 to 20% of your portfolio, right? We have futures trading here at AGT as well, and I talk to our futures brokers, and same idea. Futures should not be 100% of your portfolio, right? You shouldn't have all of your money and retirement money into futures because it's volatile and there is a lot of risk. You can make a lot of money, but also risk. You can risk a lot of money. So the idea is to allocate 10 to 20% of your portfolio to a riskier asset classes and potentially option strategies, and still have majority of your portfolio either in bonds or money market fund or in equity that's doesn't go through beta at least one or less, right? Where as long as stock market continues to go higher, majority of your portfolio is going to recover, right? Cash is very important for adjustments, right? You never want to be in a situation that if the market is down 10%, you get on a margin calls, right? That's one situation we've all been in, but you want to avoid. So you constantly, I'm on daily basis. So at least once a day, I'll look at my cash. And if I think right now market is oversold, okay, I can deploy some of my cash to buy stocks that I like. Maybe I want to buy Google, or maybe I want to buy JP Morgan because it's way oversold. And vice versa, if the market gets to overbought position, then I want to raise cash. But I never want to be situation where I look at my portfolio and my cash is zero, right? Or less than 5%. I would argue right now, if you're bearish on the market, you probably want to be 40 to 50% in cash. If you're bullish on the market because you think it's oversold, then you want to be 20 to 30% of your portfolio in cash, right? And that varies. Hedges, right? Popular hedges, VIX calls or call spreads, spiders puts. In our live trading room, I've been trading pretty aggressively QQQ put spreads or QQQ puts. Keith mentioned energy names. A lot of our signals in our AI models are being generated on a daily basis on energy-related names. It doesn't have to be oil companies, but it could be fertilizer companies, or it could be oil servicing company like Schlumberger, Halliburton, or it could be companies that are upstream, right, that are benefiting from higher energy prices. So I would say 10% of your portfolio are these hedges, right? And they're leveraged, right? This S&P puts. If you buy one contract, usually it's more than your entire portfolio. If your portfolio is $10,000 and S&P is trading right now at $650, you buy one contract, that's $65,000, right? So it's pretty leveraged trade. Bonds, this is old slide. I mean, bonds have been doing okay, right? The interest rates will continue going lower. Now I'm not sure how well bonds will work, especially if there's a fear of inflation and 10-year yield continues to go higher, yield curve is flattening. Bonds might not be a great way to hedge, but overall, over a long period of time, bonds have been a good vehicle to hedge your portfolio. Municipal bonds, you can get that tax-free stream of income as well. And depending on the portfolio, you don't want to put more than 3 to 5% of your portfolio into individual names of the stocks. In the live trading room, I advocate that don't risk more than 2.5% of your portfolio per trade and only have 4 positions. So your drawdown is 10%, especially when you're new or you start trading. Keith, any feedback on what are your allocation rules when you manage your portfolio?
Yeah, I mean, I think all of this is pretty good. Is a good baseline. Obviously, depending upon the time horizon of your money and things like that, that's going to shift your allocations around. I think the biggest thing that I would say, since I focus so much on the option side, is in regards to hedging. Generally, I try to say keep it simple. If you're trying to hedge market exposure by allocating to a different alternative investment or going into gold or going into bonds, the correlations there do shift. I know that when the market goes down, SPY puts, especially if they're longer term, will appreciate in value. So if the hedge is getting more complicated than the portfolio, then all I'm going to do is create a muddled mess, and I don't want to do that to myself.
All right, thank you. So again, we live in the world of AI, and AI is definitely in the finance world. So a lot of these topics, you will be able to use AI to give you an answer, right? So here's the AI bot inside of an Avant-Garde that is aware of who you are and what your positions are and balances are. And we are working on basically, you can ask what is the, you can ask what is the portfolio beta, but you can also ask what is my portfolio beta, right? And right now, for this presentation, we didn't make it, but hopefully next time I'm back, I will give you a demo. So be sure to come back next time where it can actually go through all of your positions and tell you what is the portfolio beta, what is the Sharpe ratio, what is the portfolio delta. Some broker dealers have this information, some probably don't, but this is something that you should be able to get when you ask a broker bot. You can also run different simulation, right? Going back to modern portfolio theory, you can say, look at all my positions, my goal is 10, 20, 30% return, and it will tell you, run the Markowitz model or some other model, portfolio theory models, and tell me what should be appropriate allocations to each of these asset classes, right? And this type of analysis, you want to do it with your broker dealer, or if you have an advisor, always ask for that information, right? Because 10 shares of JP Morgan and 10 shares of NVIDIA are not the same, or Philip Morris, right? There's different companies. You can, there are a lot of people. That's the most common question. How many shares do I buy? Do I always buy 10 shares? Do I always buy 1 shares? Do I buy 1 contract, 5 contracts? And the answer is no. You have to have a different percentage of weight based on your risk tolerance. So you would have to run some kind of a modern portfolio theory to get these allocations. But that's coming soon, and once we next time I think we are here, I'm back in April, so I will give you a demo of my account where it would go in and look at all my positions and give you what the most appropriate allocations are. So that's Winston. Not Winston. This is actually going to be AGT broker. And that's AI. All right.
Yeah, thank you so much, Vlad and Keith, for going through all of that. I know, as you mentioned, people will likely have questions after the fact, so they do some more thinking and reflecting on their own portfolios, their own risk tolerance, their own goals. So I encourage everyone to write down this contact info. You can reach out to Vlad directly and ask any questions that you may have about this presentation specifically. We did get a question that came in, Vlad, while you were speaking. What do you do in your opinion in this scenario where if you have a lot of cash, but because of the options, Your buying power in stocks and options is very low. How would you deal with that scenario? And then the follow-up is, does this ratio depend on where you actually have a brokerage account? You might not be able to answer these questions, but in your best opinion.
All right. In my opinion, again, the idea is this barbell shape approach, right? You don't want to be down 10% of your portfolio, especially if you start trading and you're leveraged, option trader. So if you have 4 positions, the idea is not to lose more than 10% of your portfolio, 2.5 for each of the position. So if you trade in options, that means 80% of your portfolio is in cash, right? So you can take that cash, right, and you want to be conservative with it. So you can put it in money market fund, right, and we're still getting 4% in the money market fund, or you can buy stocks. Or in my case, in the live trading room, I buy JEPQ, right? So JP Morgan has these dividend or cover called portfolios that consist of blue chip stocks, right? They have something more low beta, high beta, but something that continue to give you a monthly stream of income. So I would I would have 20 to 30% of my portfolio in cash, and then another 20 to 30% in JEPQ or value stocks, right? That give you monthly stream of income. And sometimes I do hedge them, in current conditions, even though I do get monthly stream of income, but the drawdown could be, depends on how aggressive these portfolios are, could be also 20, together with the market. So then I would buy QQQ put spread to hedge that. But I would, in these portfolios, usually I would not sell JEPQ because this is kind of my core portfolio. And, I can increase or decrease my allocation, but these are blue chip stocks that pay me dividend, and I'm holding them for a longer term, right? I don't day trade with them.
Okay, great. Thank you. And thanks for the question. And I'll just do one more reminder to everybody you can go ahead and reach out to Vlad and his group directly if you have any other questions on this webinar presentation specifically. We are going to be wrapping up the lunchtime options trading here. We'll definitely have Vlad and Keith back. Just a reminder, you can find out more about the webinars Avant-Garde hosts on the education tab. Scroll down here, you click the upcoming register now button to register for future webinars. I encourage all of you to do that. And later today, probably, there will be, if not today, tomorrow, there will be a new archived webinar from today's session. So if you click the webinars archives, you can access all of our past recordings of our free educational webinars. This afternoon's webinar will be there as well. Please keep an eye out for an email from Avant-Garde. It's coming from info@tradeagt.com, and that's going to have the link to the recorded replay as well. So if you don't want to find our website and worry about it, you don't have to. We'll send you an email link directly with that recorded replay. So just check your inboxes, check your spam and junk folders, mark us as not spam, and take advantage of rewatching our free education. We appreciate everyone taking the time out of their schedules this afternoon to join us. Thank you, Vlad. Thank you, Keith. And we look forward to having you two back and seeing everyone else again at our next free educational webinar. Thanks a lot and good trading to everyone.
Thank you. Thanks a lot, guys. Thank you.
Yeah, thanks again,
Bye-bye.
everyone.